rental property versus stock market. What's the best investment? So we're going to look at that today from the eye of a growth investor. Which one of them is a better investment? And we're going to discuss some topics that you're not going to see anywhere else. First of all, we're actually going to see a head-to-head comparison. I've got the numbers going back a few decades. Then we're going to talk about how to save tax on rentals with things like smart use of whether or not you should record depreciation, that's called CCA, and also how to properly record the sale, the capital gain when you sell it. A lot of people really get that all wrong. Then we're going to talk about a really unique strategy, the leverage. To what extent is borrowing when you buy a rental property, how big your mortgage is, how big of a factor is that? And you're going to see it's absolutely huge. So this is the unconventional wisdom insights into which is a better investment, rental property or stock market. Okay, what you're going to learn today is how does growth of real estate compare with the stock market? What are the sources of rental property returns? What's the normal return for each source of returns for rental properties? How does the total return on rentals compare with the stock market, not just the growth? What are the best and worst types of rental properties that we've seen? How do you minimize tax on rental properties? Should you deduct the depreciation that's called CCA, capital cost allowance, on your rental? How do you record the sale of your rental on your tax return? How does the size of the mortgage affect the return on your rental? How do different amounts of leverage affect returns of rentals versus stock market? And that's a comparison you've never seen anywhere else. It's really cool. Then I'm going to give you Ed's rental property rule of thumb and what is Ed's general advice on owning rental properties. So first of all, let's just do a direct comparison of growth. Okay, this is the growth part of it. A lot of people think that real estate growth is, somewhere close to the stock market, but it's actually nowhere close. Okay, so I've got the actual numbers since 1975. This is the Toronto real estate versus the Toronto stock market. And you see Toronto real estate is this purple line way down here. In 1975, the average house price in Toronto was around $75,000. Now it's around $1 million. However, this is the Toronto stock market, and if you put the same amount of money into the stock market, you'd have over 5 million. So it's more than 5 times the growth. And notice that the house prices are actually not a lot different from GICs over this period of time. Now, also, if you're investing in the stock market, you can easily invest in the US or globally. And there, instead of having that 1 million in real estate, you could have almost 10 million in global stocks and 12 in US stocks. So the growth of the stock market, first of all, is way higher than rental property. Okay, that's the growth part. Now, just to show you how much higher it is. So let's say, when you typically buy a home or property, you put 20% down on the property. And if all you did was put that 20% down, take that down payment and put it in the stock market over 45 years here, from 75 to now, the down payment alone would have grown to quite a lot more than the value of a home. So this is good news if you're a renter. Okay, because you think, some people think I don't want to buy a home, or I can't. Maybe a lot of the younger people think now I can't ever buy a home. But if you take the down payment that you would have put into a home, just put that into a stock market, and you could actually have way more than you actually have from the home. So if you bought a home for $75,000 in 1975, it'd be worth about $1 million now. However, if you took 20% of that, which is like $15,000, and put it in the stock market, you'd have more than that, a little bit more than that in Canadian stock market, almost 2 million in the US and 2 million globally, 2.5 million in the US. So you'd actually have, you'd have 1.5 or 2 times as much just by investing the 20% down. So that's how much higher the growth is of the stock market versus rental properties or versus real estate. Now, there's a lot more to this story, though. If you know about rental properties, there's a lot more to this story because the return is a lot more than just growth. So rental properties, there's various sources of return. Okay, so first of all, there is a cash flow. It may be positive or negative, but there is a cash flow that you get with a rental property. Now, you're also slowly paying down your mortgage, right? When I talk to rental property owners, they always talk about, my tenant's paying my mortgage. So that's going on. Then, of course, there's the growth. Now, you do some work to manage it. I haven't really tried to value that, but I just want to point out there is some work involved in managing a rental property, which generally there is not, or you can do a stock market without that. Then there's the tax effect of it. And then we're going to look at leverage, various amounts of leverage and how that affects it all. It's a really cool factor to see when you put all that together. And then you'll see how much leverage that you use is the main factor in returns. And that's why it's really important to understand if you're thinking about rental property or stock market, it's a big thing to understand. So let's talk about those various sources one by one. First of all, the cash flow. Now, typically, most of the cases I see with a rental property, the cash flow is typically zero. It might be slightly positive, a couple $100 a month, or a lot of the ones I see are negative a few $100 a month. So, but typically it's around zero. And actually, there's a reason for that, is because the market tends to create a balance between owning and renting. So, in general, the monthly payments when you own is usually not a lot different from the monthly payments when you rent. That's generally the case. That's why you get this balance. And most of the cases I've seen in rental properties, that's what I've really seen. Now, effective owners look for a cash flow positive properties. So if you're a really, really good investor in rental properties, that's what you would look for. A good rental should be cash flow positive with 100% leverage. So I get the largest mortgage and borrow even the down payment. So this is kind of my insight into it. So if you take a rental property, let's say that you got a mortgage for 75% of the property, but you also borrowed against your house or somewhere else, you borrowed the 25% down. So you borrowed 100% of it. Now, a good rental property should cover all those payments and all the costs of it. So, and still maybe break even or be a cash flow positive with all that involved. Now, a lot of the rental properties I see around here in Toronto, people like to buy condos because there's not much work involved in them. Problem is, condos are not really that effective as a rental property. So the ones I've seen, typically, they're about let's say 400 or 500 per month negative cash flow. So, and you see that in Toronto, we've gone a little bit out of whack. Okay, so if you have two identical condos, one person is renting and the next person in the right beside it in an identical one owns it, you'll see the person that owns is probably paying 400 or 500 bucks a month more than the renter. Again, good news if you're a renter, because if you live there and you put you invest your down payment, also invest your 400 or 500 bucks a month savings, you can be way ahead over time. So things have gone a little bit out of whack there. Now, also, this cash flow depends a lot on the property. So a good rental property owner will search around, find something with a good cash flow. Now, here's what I've seen, because I've seen quite a lot of people owning them in different ways. Some are our clients and some are not. But the most profitable ones that I've seen, there's a reasonable number of Airbnb ones now. Airbnb are charging actually, like it's short term, but you're actually charging, if you rent it a lot, you're actually charging a lot more than if you rented it, by the month. And so they tend to be quite profitable if you rent it out quite a bit. So now it is more work, obviously, because you got to clean it up like every day or every few days, but it is one. Another one is student housing, because you get 4, 5, 6 students in a house. Now that's a whole new skill, because you got to deal with all these students that may fight and leave and that kind of thing. But they tend to be pretty positive cash flow. Also, multiple units, like a fourplex, and especially on older homes. So these tend to be the most effective rental properties, with the best cash flow. Worst cases I've seen, vacation properties. Like a lot of people, they go on a vacation, and once they, while they're there, they get presented with buying a property. They love this place, and then the management there will rent it out. But usually those, are quite significantly negative cash flow. And you think, well, it's because I also get to stay there part of the time. But like as a rental property, that's usually one of the worst ones out there. Another one is new construction homes, like if people that are, live in a nice big 4-bedroom home and they see another fairly new place in their neighborhood or something being built, and they're buying these, big 4-bedroom homes. They're usually pretty negative cash flow as well. And again, as I said, condos tend to be. So those are probably the worst rental properties, the best and the worst. All right. So when you look at cash flow, you should assume it's fully mortgaged. Think about that. If you whatever mortgage you get, figure out how much the payments would be if you mortgaged 100% of the purchase price, and can you still cover all the costs? If you can, then it's probably a pretty good rental property. Okay, so let's talk about the mortgage being paid down. So again, lots of rental property owners say that tenants are paying down my mortgage, and that's part of the benefit. So now your cash flow, let's say your cash flow is even, the rent just pays all the cash flow. However, you are paying your mortgage down. Okay, so that's a plus for you. Now, typically, if you have a 25-year amortization, you're paying down in the early years about 1.5% of your mortgage a year. Okay, so that's roughly, think of that as a rate of return of 1.5 or something, because it's being paid out of there. Now, the thing about it is that it is taxable. And the reason is because you're collecting rent, which is fully taxable, and you're paying the mortgage. And the mortgage is the interest deductible, but this portion, the principal portion, which is your profit kind of, is not deductible. So think of that as that's profit you're paying, but you're paying tax on it every year. Now, principal payments are the main reason that we get this weird anomaly that I've seen a lot with rental properties. So you have see people that they have a rental property that is a negative cash flow. So every month they're paying 300, 400, 500 bucks a month out of their pocket for it. And yet, the end of the year, they go to their tax return and it shows, oh, you made 5,000 bucks on your property and you have to pay tax on it. You think, well, why am I paying tax when it was negative cash flow all year? And that's why. It's because you're paying down some mortgage, which is taxable. So it's negative on the cash flow, but it's also taxable. So it is a plus, but there are, some negative sides to it. Now let's talk about, so another part of the profit of a rental property is the growth. So now the long-term average here in the Toronto area since 1975 has been 6.4% a year. So that's pretty good. Now stocks have done quite a bit better, but 6.4 is actually not a bad number. So we're going to include that. This is probably higher than maybe we should long-term expect. Long-term returns have been more like 4, like a little bit above inflation, but let's use 6 in our estimates here. Now, also, rental property is a part-time job, so there's work involved in it. You have to find and screen and manage your tenants. You got to get a mortgage and organize all the financing and the cash flow. You got to do repairs and maintenance. And from seeing a lot of people rent and be landlords, and I was a landlord in the past. I used to own a couple of apartment buildings. And I can tell you the biggest thing is screening tenants, learning how to screen out tenants, doing the credit checks on them, using your gut on who are good people. Screening tenants is a huge thing because you get one bad tenant, it's a total nightmare. We've had clients that had a rental property, had one disaster tenant, and then that was it. They never want to be a rental property owner again, and they just sold it. And then others have just great, beautiful tenants, like tenants that are easy to work with and do all the basic stuff and never bother them and pay the rent on time. And so a good tenant is what makes it really easy. So this is screening the tenants is a huge piece of it. Then of course there's bookkeeping and tax returns, and this is all the work that's involved. Now a lot of this you can outsource, right? So you can pay for a property manager, you can pay for maintenance people, and pay for an accountant, but that does eat away at any profit you may make on this. Now, one way to look at this kind of is you look at this, how much time do you spend in a month or a year all together, everything included on your rental property? And you think, well, how much am I actually making? What's the profit on this rental property? How many hours do I spend? What's the rate of return that I'm making it? Another way to look at it is take a look at the rental what you're paid per hour for your job. And let's say that your rental property paid you by the same rate for the amount of time you spend for your rental property. How much would that be, and how does that affect profitability? Now, this is very subjective, and a lot of rental property owners don't count it because I just do it on the side. So in this analysis, I'm not actually going to count this at all, but it is a factor, and it can be a fairly significant factor on some properties. Now let's talk about tax issues with rental properties. So first of all, the net rent is taxable. So rent after expenses is taxable each year on your tax return. You got to record it and show it all on there. So, and now remember, the mortgage principal is a non-deductible payment. So it's part of the cash flow that you're paying, but you don't get a deduction for it, just the interest part of the mortgage. Now, the growth of the property over time is a capital gain. So somewhere down the road, you sell your property, you make a profit, hopefully, and that gain is 50% taxable. So if you make 200,000 gain, 100,000 shows as taxable income that year and is added to your income, so you'll pay a bunch of tax on in the year that you sell. Now, interestingly, getting a little political insight here. So rental properties are actually one of the main flaws in the government's argument that capital gains are mainly for the rich. So the thinking is there was thinking that they were going to raise the capital gains inclusion rate. So right now, 50% of gains are taxable, and they're thinking of raising it to 75. And the argument is it's only the rich people that get capital gains. So it's people that have already maxed their RSPs and TFSAs, so they have non-registered portfolios, and they're getting the capital gains. The problem is there's quite a lot of like ordinary, common, middle class people that own rental properties. Okay, and People with a very modest income will own a rental property for many years and then sell it for a profit. So in that year, their income is high, even though it's normally modest. All right. So for example, let's say someone who makes 50,000 a year and then they own a rental property for 30 years and finally sell it. In that year, they have their tax return that says they made 500,000. Now the government will say, "See, it's people that make 500,000 that pay capital gains." Right? But it's not somebody who normally pays it. They just paid it that one year. Okay, so that's kind of the flaw in that thinking. Just I thought I'd give you that little insight. So the reality is a large portion of capital gains tax is paid by middle class people with regular investments and rental properties and this kind of thing. Now, how do you minimize tax on your rental? First of all, you got to record all your expenses, keep track of them all. Now, one interesting thought here is repairs and maintenance are expenses, but renovations and improvements are not. So if you improve the place or do a major reno, that's not an expense. That's added to the cost of the building. So you get a smaller capital gain when you sell it. Now, mileage, so you can actually record the cost of your car. So you should track how much you use your car for the year, how much did you use it for the rental property, and then record all your car costs, and you can deduct that percentage. Usually with rental properties, this is very low because you don't really drive around all that much. And one of the rules there is that the mileage that's allowed for rental property is only within its own city. So let's say you live in a different city and you have to drive to that city to collect the rent or do maintenance there or something like that. The distance between the cities is not considered a rental property expense, just driving around within that city, like going to get I go to the lumber yard and buying some parts and doing the repairs, that kind of thing. Now, we're going to talk about making a smart decision on whether to claim depreciation, which is called capital cost allowance. So most people either don't know about it or don't have no idea should they claim it or not. And I find even usually accountants aren't really very good at giving advice on this. And now here as financial planners, I can tell you exactly how to think about it and how to figure out whether you should do that or not. And then we're going to talk about calculating the tax on the sale property. So CCA. So first of all, what is it? So what it is, you're allowed to claim a deduction of 4% of the building each year. Now, this is the building only, not the land. So when you buy a property, you need to specify how much of what you pay is building and how much is land. Now, the problem is it's not that easy to figure that out. Okay, like you could just do your own research, like what would a vacant land cost in my area, and try to figure out the difference. And most in the cities in the GTA here, for the houses, it's actually, believe it or not, it's about 2/3 land. Most of it is the land. Now, as often done for simplicity purposes, and when you're buying a home, a lot of people just do 50-50 because they don't really know. It used to be that there was values on your property tax. There was a home value and a land value, but that's rarely there anymore. So a lot of people just take 50-50. On condos, it's kind of think, well, I just own my little area and a condo, so I don't really own any land. Now, technically, you do own some land because you own a part of the overall building, and there is some land, and it's pretty valuable land actually that it's on. So you technically own it, but it's really hard to figure that out. A lot of people with condos just put it as 100% building, which is probably not right, but that is probably what most people actually do. All right, so you take your cost of your building, and you can claim up to 4% a year every year. Now, you can't make your rental property a loss with CCA. So you can only claim enough to eliminate your taxable income from it. So you can't make a loss from it. Most of the time, that is enough to offset the net profit that you make. So usually, the cash flow is not much, but you're paying down the mortgage away, so you're making some profit. But in most cases, the CCA is more than that. So if you claim CCA, you generally have no tax at all over the years. Okay, so that's kind of the cool part about it. Okay, so for example, you have a $500,000, you have $1 million property, 500,000 is the building, and so 4% is about 20,000 a year. Well, you're probably paying, let's say 15,000 is the mortgage pay down, which is taxable if the cash flow is even. So then you see the CCA is actually more than your net profit on it. So it probably wipes out all tax. So that's the cool part. Now, the other side, the negative part is when you sell the property, the CCA is what's called recaptured. So the government recaptures it. And what happens, that amount is fully taxed. So now this takes a little understanding to figure out, but let's give you an example to give you the concept. Let's say you buy a rental property for 500,000 and you sell it for a million, 20 years later or something. And meanwhile, you've deducted 4% depreciation every year. So your book value has gone from 500,000 down to 250. So when you record depreciation, your book value goes down. So remember, your book value starts with what you paid, basically. I'll talk a bit more about that in a minute, but it's your book value and it gets reduced by the CCA every year. So let's say you brought your book value down to 250,000 by claiming 250,000 of CCA over the 20 years. Okay. Now you sell this place for $1 million. Okay, you bought it for 500,000, you sold it for $1 million. Now, first of all, your book value isn't 500 anymore, which is what you paid. It's down to 250. And what they do is they take all the CCA that you've paid over the years, that 250,000, and it's called recaptured, and that amount is 100% taxable. And then on top of it, from 500,000 to $1 million is a $500,000 capital gain, and that's only 50% taxable. Okay, so 250,000 of your CCA recapture is taxable. 250,000 of the 500,000 capital gain is taxable. So there's 500,000 taxable income. So you take whatever you made on that near normally, add 500,000 to it, and that's how much tax you'll pay based on that. So that probably means that you're going to go into the highest tax bracket is 54%, starts around 230,000. So quite a bit of that gain is going to be at the highest rate, not all of it. But let's say you pay 50% tax though on that. So 500,000 gain, 50% tax, you're paying about $250,000 of tax on this sale. So you bought it for 500, you sell it for $1 million, you made 500,000, but you pay 250,000 tax on the sale. You didn't pay any tax over the 20 years on it. However, you have to pay 250,000 tax at the end. Now, if you didn't claim any CCA at all, then your book value stays, around what you paid for it, and all you have is the capital gain. Now, that's $500,000 capital gain. It's only 50% taxable, so 250,000 is added to your income. So now you may or may not even be pushed into the 54% tax bracket. So you're probably paying more like 40% tax on that 250,000. So maybe 100,000 tax. So CCA, notice what's happening here is you spent 20 years where if you claim it, you basically pay no tax. But if you don't claim it, you're paying some tax every year on your net rent. Okay. But then it's the opposite when you sell it. You've saved tax for 20 years, but now you get a big hit at the end versus not. So now you think, well, am I better off or worse off claiming it this way? And how do I figure this out? And this is 20 years. What if it's 10 years or, how do we figure this all out? So here's how you figure it out. First of all, compare your marginal tax bracket today versus what you estimate it will be when you sell. Let's take, for example, that is 30%. 30% tax bracket is for people whose income is between 50 and 100. So generally, the first 50,000 is very roughly is around 20%. From 50 to 100,000 is about 30. From 100 to 150, it's around 40. And then from 150 up to 230, it's close to 50, and then over 230, it's 54%. Okay, so those are, but anyway, take your marginal bracket that you pay, that's the tax on the next amount of income. So let's say it's 30%, and let's say that, you're going to keep this for quite a few years. So think about how many years you'll keep it and how much of a gain, how much is going to be taxable in that year. Let's say you claim depreciation, so you can have the recapture plus capital gain. And how high will your income be? But let's say, for argument's sake, you're 30% today, and you're going to pay 54% down the road. So how do you figure out if it's worth it? Well, the way we look at it is, let's take that the tax that you save. Let's say you took that and invested it. So if you have regular investments, you can put in your TFSA or something, invested in stock market investments, which make 8 or 10% a year or something like that. So in general, the question is, if I'm saving 30% tax, so let's say $10,000. 30%, I get saved $300, and I save that up every year, and I eventually go from $300 up to $540. How long would it take for $300 to grow to $540? So now, if you're a growth investor, it would take about 8 years. So that's making, the stock market return, making about 8%. 8 or 10%. If you're a moderate, balanced investor, it'd take more like 16 years, like, making 5% a year. So the general thought is, do this calculation with whatever numbers make sense for you. I'm just giving you the method to do it and some possible numbers. So the question is, how long would it take to grow the annual tax savings into enough to cover the higher tax bill when you sell? And the question is, will you own the property that long? So generally, my advice is only claim the CCA if you plan to own your property for at least 10 years for growth investors or 20 years for moderate investors. If you're going to own it for 10 or 20 years or more, can have it for the long term, then paying the CCA, like taking it every year, is probably worthwhile for you. It's an overall benefit. You save tax for 20 or 30 or 40 years, and then you get a big hit, but it's way down the road. So, and meanwhile, you've got that extra, money that you didn't pay tax every year. So that's kind of the way to think about it. But if you're going to sell it within 5 years, you're going to claim a bit of CCA and then get a big tax hit. It's only a few years. Then you're probably better off not claiming CCA, just pay a little bit of tax each year and then pay less when you sell. All right, so on a capital gain, calculate the tax on the capital gain on the sale. Now, a lot of people do this wrong, and they end up paying a lot more tax. They risk getting audited by CRA. And remember, CRA doesn't calculate it for you. They just look at your number and they just allow it or disallow it. You know what I mean? So it's up to you to come up with the right numbers. So first of all, there's 3 components of this sale. Let me tell you what they are and how to get them. First one is the book value, and that's when you buy the property. So it starts with what you paid, like your purchase price, but it's not just that. There's other costs when you buy it. There were legal fees, land transfer tax, you may have mortgage fees and appraisal fees and whatever other fees. What you should do is find you get a package, you get the stack of paper from the lawyer when you buy the place, and there's a sheet there, it's usually a page or two, called Statement of Adjustments. And look through that and pick out everything that's a capital cost or that adds to the building. Okay, so for example, they have an adjustment for property tax and interest, like current expenses, ignore all those. But basically everything else is part of the cost, right? So you'll see legal fees are there, land transfer tax, and all these any other lump sums that are in there. So take what you paid and add those on, and then you've got a book value, and that's what you should keep. Because if you're going to claim CCA, that's the book value. You have to put that book value in on your tax return and then claim your, up to 4% on it. Now, remember, so repairs and maintenance is an expense every year. It's tax deductible. Renovations and improvements add to the book value, and they're not tax deductible, but they add to the book value, and you can claim CCA on them. So let's say you buy a place and then you do 100,000 renovation on it. Keep all the receipts, add it all up. Then you add it to your book value, you put that on your tax return, and now you can claim 4%. So you can't write it off, but you can claim 4% a year again of it, okay, over time. But you got to go through the effort of recording it. So that's the book value. Then the second part is the total CCA since you own the property. When you sell the property, you actually got to add up all the CCA that you deducted over the years, and that's a recapture, and it's 100% taxable. Now, that's assuming that the property went up. If the property went down in value, then it's actually not a recapture. So that can, it can help you that way because it's a bit of a tax offset if you lose money on the property. But, most of the time they're going up. And so that part is 100% taxable. Then you need to look at the proceeds. And people think the proceeds is just, this is what I sold the property for. Is the selling price, that's the proceeds. But it's not. It's not just that. So it's the selling price minus all the costs. So there's a few big ones. Like usually there's commissions like 5% that you paid to the real estate agent. Again, there's legal fees and our costs of breaking the mortgage. And so again, you should go through the lawyer's statement of adjustments. You get this package for the lawyer, find the statement of adjustments, look through there, find anything that's not a current expense. And then so you're selling price and you're subtracting all these things from it. So you get your net proceeds then is quite a bit lower than the overall selling price. Okay. Now to put it together, there's a capital gain, which is, first of all, you get a recapture, which is the total CCA. And then you take your book value plus all the CCA, and that's what gives you the base. And then the proceeds, the difference is the capital gain. So for example, remember it's a $500,000 property, grew to $1 million. You wrote off $250,000 over the years. So it's down to $250,000. Okay, now total CCA is that $250,000. So that's the capital gain. Now, if you take the book value, which is now down to $250,000, add back all the CCA, you're back to 500,000, which is what you paid, and plus whatever the cost. And that difference between the million and the 500,000 with all the adjustments, that difference is the capital gain, okay, which is 50% taxable. So that's the process. And so the notes are all here. You may want to go through this again. I also have the notes on my blog if you want to refresh yourself. So it's something a lot of people record this wrong. So it's a good one to do because they're big adjustments that you're making. It could be quite a lot of different of extra tax that you'd save by doing this right. Okay, now let's take a look at the total return of a rental property versus stock market. And this is different. Like I showed you the difference in growth, and the stock market growth is way higher than the rental property. But let's look at the other parts. Let's look at the total return. So here's a number. Let's say that we have 25% down, which is what normally happens with a rental property. The bank requires you to put 25% down. So let's assume that the cash flow is break even, which is what I very often see, but you're slowly paying your mortgage down. And that, on average with the 25-year with 25% down is around 1.5%, of the value of the property that you're making from there. Then there's your effort and work, which you could deduct from this if you think it's valuable. If you want to contribute it for free, let's just assume that's zero for now. And then the growth of real estate since 1975 here in the Toronto area is about 6%. So you should look at your area and see what the growth is. And it's more to what you're trying to figure out is what you really want to know is what's it going to grow in the future. Now, the Toronto real estate here has probably grown more than it should long term. So I'm not sure that 6% long term is really a good number, but it has been growing that much over the long term. And we do have a structural imbalance here. We've got a government that really doesn't know how to run things. And they're bringing in a lot more immigrants than we have properties, than we have homes for. And that creates a mismatch of balance. And that's what's kind of pushing property prices up. But a lot of them are coming here to the Toronto area. So that's part of why it's, prices have gotten kind of out of whack, and they're probably going to keep going up. So for the same reason. So let's say we make 6% on the growth, 1.5% on the mortgage, cash flow 0. We're not going to count work. So you've made a 7.5% return. Okay, so now that's looking at the total return on a simple basis. So now the long-term average of the stock market, let's say it's 10. So the worst 25-year return of the S&P 500, that's the U.S. return where we have the longest stats, in the modern stock market has been 8% a year, which is already more than the 7.5% for real estate. And the actual return, the actual return of real estate has been around 6. If you look at the same period of time since 1975, the Canadian stock market's averaged 10.6% a year, the US 11.9. So they actually done 10, 11. But so let's just say 10 for a factor. So 10 for stock market, 7.5 for rental property. So that's 2.5% higher. Now, the thing is, if you compound this over, a few decades, you'll find that difference is absolutely huge. So, that the rule of 72, if you want to give a rough idea. So, 72 divided by the rate of return is how long it takes your money to double. Okay. So if you're making like 7.5%, your money's going to double. Your property is going to double about every 10 years. Okay. However, with the stock market, at 10%, it's going to double about every 7 years. Okay. So let's just go 21 years out. Real estate would double twice, and the stock market would double 3 times. So you already double the amount on there, right? So you get 2 doubles versus 3 doubles, and you end up so you have double as much. So that 2.5% may not sound like a lot, but over 20 or 30 years, it's actually a huge number. Now, here's the really cool part. How does the size of the mortgage affect your return? Now, typically, the banks require you put 25% down on a rental property. So it's 20% for homes, 25% usually for rental properties. So the money that you've invested in this rental property then is the down payment. Okay, so that's really a 3-for-1 leverage when you look at it. Okay, so you put down a quarter of it and you've borrowed 3/4 of it. Now, so here's an example of how the leverage effect can have an effect. So let's say that's $1 million property for a nice round number. You put $250,000 down, got a $750,000 mortgage. So again, let's say cash flow breaks even. You're paying some principal, so you're probably paying down. If you have a regular 25-year mortgage on $750,000, you pay about $15,000 of principal, in the first year. And then the growth, let's say it's 6% growth, and that's not on the lower, it's on the full value of the property, right? The whole million. So that would be $60,000 a year plus your $15,000 for the mortgage pay down. You've made $75,000. Now you think 75,000 on a million, that's how you get your 7.5% return, right? However, the thing is, you've only put 250,000 down on it, right? So the rest of it was borrowed, and we counted the mortgage interest in your rate of return. So you've only put 250,000 in, and you've made 75,000 on it. So that is a 30% rate of return. That's actually not bad. So that's how you think of it. So when you're looking at the leverage effect, it just completely changes the picture. So now your return isn't 7.5, it's 30. So this is why I can say, in general, a rental property with a large mortgage can be a good investment. Now let's look at the different levels of leverage. So again, $1 million property. So I'm going to look at, let's say the equity is 0, 25, 50, 75, or 100%. Okay. So 0% equity means you bought $1 million property and you borrow the entire million. So you got a mortgage of 750, 1,000, and you borrowed from somewhere else or against your home. You borrowed the other 250. So you borrow the entire million. Okay. Now what happens here is you got $1 million and you're paying this down. You probably only, if you let's say you're making the same mortgage payment that you did with a $750,000 mortgage, you're only paying about $1,000 of principal down on your mortgage a year. And let's say half of that is taxable, so it's $500. So you're only up $500 on that. So now the growth is 6% of the million, so it's about 60,000. So you made 61,000 on it. However, you have invested 0 and you made 61,000 on it. Now, if you do a rate of return on that, your computer is going to go berserk. It's going to say you have an infinite rate of return because you invested 0 and you made money on it. So that's an unbelievably high. You can't possibly have a higher rate of return than that. All right. So then the normal case is you put 25% down, $750,000 mortgage. Now you're paying about 12,000 of principal down. You pay tax on that. Let's say about half of that is 6%. You're paying 6,000 of tax. Again, you make your 60,000 of gain from the growth. So your net profit after tax is about 66,000. Now you put 250,000 in, so it's about 26%. So the last example we had 30. I've worked out a bit more precisely. It's about 26%. Okay. Now let's say it's only you put half of it down. So you put 500,000 in on the $1 million property. Now your principal, you keep the mortgage payment the same. You're paying about 23,000 of principal, which again is, let's say that's your profit. So the smaller the mortgage, the more it looks like you're making a profit on it, but also you have to pay more tax on it. So you pay half of that 23,000 in tax, 11.5, plus your 60,000 is the growth again. So you've got an after-tax profit of 71,500 on this, but now you've invested. It's only a little bit higher than the other examples. However, you've got 500,000 invested now, so you're only making a 14% rate of return instead of 26. If you put in 750,000 of your money and just borrowed 250,000, so it's 75% equity, your rate of return ends up being about 10%. And if you bought nothing, so let's say you have no mortgage on it at all, then the same payment that you were making, your cash flow probably supports. So that's about 45,000 a year, but you pay, let's say, half of it in tax. So once you have a paid off rental property, it puts off a lot of cash, but it's 100% taxable. So let's say it's 45,000 of cash flow that you get net rent, but you pay half of that in tax, so it's 22,500. And then the growth again is the 60,000. So now you've made a net profit of 82.5. However, you've got $1 million of your money in it, so it's only 8% rate of return. So notice this: with $1 million mortgage, you've made an infinite rate of return. With a $750,000 mortgage, you've got a 26% rate of return. A $500,000 mortgage, you made 14%. A $250,000 mortgage, you made 10%. And no mortgage, you made 8%. So I think a lot of rental property owners make the mistake of thinking, I'm trying to pay off the rental property for later. However, as you pay your rental property down, it gets to be a worse and worse investment. So it's much more effective to keep a big mortgage on it all the time. That's how you get a big rate of return on it. Now, let's compare similar numbers to the stock market. Now, a lot of people don't realize that you can actually borrow a similar amount on the stock market. So let's see what that looks like. So again, let's say that you borrowed the whole million, which is actually hard to do, unless you have a lot of equity in your home where somebody will lend it to you. It's actually hard to do this kind of thing. But let's say you borrowed $1 million, pay, let's say, 45,000 in interest on it. But you know what? That interest is a tax deduction every year. So now, remember rental property, if you're not claiming CCA, you're paying some tax every year on the mortgage pay down or on your net rent. Okay. However, when you're investing in the stock market and borrowing to invest, generally, if you invest tax efficiently, in most years, you should actually be getting a refund. So all the interest is tax deductible every year. For our clients, even all the portfolio manager and our fees are all tax deductible. So you get a nice big tax deduction every year. And usually we try to trigger as little capital gains as possible. So you're getting this refund every year. So let's say you get a 45,000 as your interest, but you get half of it back. Your tax refund is 22,500. Now your profit after tax, you made 100,000. That's the 10% on the growth. You paid 45,000 in interest, but you got a 22,500 refund. So you made a net profit of 77,500. Now here again, you borrow the whole million, so you've invested zero of your own money. So just like with the rental property, you've made an infinite rate of return. Again, no rate of return can possibly be higher than that. Now let's take the more common example, 750,000. So that's normally what happens with a real estate property. The bank requires you to put 25% down. And what's fairly easily available is 3-for-1 investment loans. So here you have 250,000. The bank will lend you 3 times that. That's 750,000. Now you've got $1 million. You put 250,000 of your money in. Okay. And so in that situation, you got $1 million in, let's say it grows by 10%. That's the 100,000 growth. The loan interest on the 750 is about 33,750. And you're getting, let's say, half of that in a refund. That's almost 17,000. So your profit after tax is a little over 83,000, but you've got 250,000 invested of your money. So you've got a 33% return on your money. Okay. Now, if you just only do a 500,000, so you could get a 3-for-1, but you don't borrow quite that much. So you borrow 500,000, you put 500,000 in yourself. We have the same numbers in here. You have about 18% rate of return. Okay, and if you put 750,000 of your money, just borrow 250, so just conservative, small amount of leverage, then it ends up being 13%. And if you have no loan at all, you just have your money that's let's say $1 million of your own money that you've invested. There's no loan at all. Then of course you just make the 100%. You 100,000, you've made 10% on your money. So again, $1 million with $1 million loan, make an infinite rate of return. $1 million with a $750,000 3-for-1 loan, you're making a 33%. With a 50% loan, $500,000 loan, you're making 18%. With a $250,000 loan, you're making 13%. And no loan at all, you're making 10%. So again, the bigger the loan you have, the higher your rate of return. Now, we looked at different leverage amounts for real estate, and we did for the stock market. How do those compare? And this is actually a really important factor because it's whenever people talk about rental properties, a really big factor is there a big mortgage or not a big mortgage? It's the main factor in determining if it's a good investment or not. Also, stock market investments, by borrowing to invest, you gross up your return a lot. Now, your risk, short-term fluctuations is also much higher, but I'll talk about that in a minute. The stock market is quite reliable long-term. So this is a very reliable strategy done by the right people over the long term in the right way. So it can actually work for you. And again, the more you borrow to invest, the higher your rate of return is over the long term. So now let's compare them. Okay. So with $1 million investment, rental properties profit after tax was 61,000 and stock market was 77,500. So it was somewhat higher. In both cases, you've got zero money invested. So it's an infinite rate of return. 25% down and $750,000 mortgage or investment loan or a 3-for-1 investment loan. You made 66,000 in profit for the rental property, which is 26%, and 83,000 with the stock markets was 33%. With a $500,000 loan or mortgage, it's 14% for rental property, 18% for the stock market. With $250,000 loan or mortgage, it's 10% for real estate, for rental property, and 13% for the stock market. And with no mortgage at all, it's 8% for the rental property and 10% for the stock market. Okay, so notice in every case, the stock market is somewhat higher, and it's also less work and generally more tax efficient. So Now, what I have not included in this is somewhere down the road, you're going to pay capital gains on these. And that's hard to build into this analysis because in most cases, it's going to be way down the road. Like how long are you going to own your rental property, 20 or 30 years or something? And the stock market, people tend to own them. Most people tend to own it even longer because it becomes part of your retirement income, right? So you build it up until you're 60 or 65 and retire, then you start taking out a bit over the year. And, like so, and if you work it out from, let's say you retire at 65 and you make your money last till 90 or 100, what you find is the peak of what you have is still around the mid 80s. So a lot of this money, like you may be 40 or 50 when you're buying it, in the stock market, this could be 40 or 50 years in there. And then there's the capital gain. So it's hard to build all that in here. When it's a gain so far down the road, it's actually not that significant of a factor in this. And because there's just too many assumptions, I didn't include those. The stock market would probably have a bigger capital gain because it's making 10 versus 6, but the rental property may have this recapture on it. So but this, I wanted you to see this with both real estate and the stock market. The bigger the mortgage or the bigger the investment loan, the higher your rate of return is. And in every case, the stock market is somewhat higher than it is with rental properties. Now, this leads me to Ed's rental property rule of thumb. And if anytime I talk to people about a rental property, I bring out this. This is my general rule of thumb. Now, it's, every property is a little bit different, so this is not going to be precise. But as a general principle, it's generally pretty close. So here's the rule of thumb. When your mortgage on a rental property is down to half the value of your property, you're better off selling it. Okay, so you buy it, you put a small amount down, and then as you pay it down, and the property grows a bit in value. Once the mortgage is half the value of the property, then you're better off to sell it. Because what you can do is you can take what your net proceeds that you clear out of that, invest it in stocks, you get a higher return, less tax, and no work. So at that point, it's not really worth your while to have the property any longer at that point. Okay. Now, one of the solutions to that is you can do the Smith maneuver on it. Or actually, there's another strategy called cash dam, which you'll find on my blog. The Smith maneuver is the one that's more effective because it actually helps you build up investments for your retirement as well. And if you do Smith maneuver on a rental property, then what happens is you always keep the leverage up about 775 or 80% of it. So you always keep it highly leveraged and your rate of return always stays high. When you do that, it's usually worth keeping this property long term. So, general property, you buy a rental property, and it's probably 5 or 10 years in that it's down half the value of the value is about half of the mortgage, about half the value, and then you're better off selling it. But if you do Smith maneuver, you can keep this place for decades, and it's always providing a high rate of return. Plus, you're doing this Smith maneuver on it, and you're having stock market investments that don't use any of your cash flow as well as the rental property. So the Smith maneuver is what can make a rental property worth keeping. And I can tell you, actually, the record that we've had clients that have done 7 Smith maneuvers. They did it on their home, cottage, and 5 rental properties, 7 Smith maneuvers running. It was kind of a bit of a job to manage it every month, but it was kind of really cool to see so much of us, such an effective good rate of return on all the rental properties, plus all the growth towards their retirement. Now, I have some general advice on owning rental properties. Some of this is common sense, but this is also my insight from seeing a lot of them and also from having a very unique insight, having written over 1,000 financial plans and being a tax expert. So, and also for my growth outlook. So here's my insight. So first of all, a rental property with a large mortgage is usually better than the stock market with no leverage. So if you're comparing leveraged real estate to unleveraged stock market, the real estate does better. So, for example, I get people that say, I have 100,000 cash. Should I invest it in the stock market or should I put it down on a $500,000 rental property? Well, you're comparing 500,000 in real estate to 100,000 in the stock market. The real estate's probably going to do better. Okay. It's not an apples to apples comparison, but if that's what your comparison is, the real estate will probably do better. Okay. So now remember, if you borrowed the same amount and you had 500,000 of each, then the stock market will probably do better over time. Now, if you buy the rental, generally what you should do is do the minimum down payment or even try to borrow the down payment. Put as little of your money as possible into it. So, usually you're going to have to put 20 or 25% in. The banks are going to require it, but just do the minimum amount, get the maximum mortgage you can get. That's usually the most effective way to do it. Don't tie up your money in it. Let your own money grow, be invested in the stock market and retirement investments and other stuff. So keep as much of your cash as possible invested. Now, also pay down the mortgage as slowly as possible. So on your home mortgage is not deductible, and you may want to pay that down more quickly. Generally, you should try to pay it off. In general, try to pay it off by the time you want to retire, not before or not much before, but paying around that speed. The rental property, generally you want to pay it as slowly as possible. 25 to a 30-year amortization as slowly as possible, because it's tax deductible. And so paying off a tax deductible, low interest debt is not an effective thing to do. Okay, so just try to pay it off as slowly as possible. Also, consider doing the Smith maneuver on a rental property, as I was just telling you. So this keeps your rental property fully leveraged, which means it always has a higher rate of return on the money that you have invested in it. And again, that can make it worth keeping the property long term. So we talked about if the leverage 5-to-1, but if you have the same amount of leverage, so you put 25% down on a rental property, or you take the same amount of money, put it into a 3-for-1 investment loan, so you have the same leverage amount. Okay, then the stock market outperforms rental properties. So with the same amount of leverage, the stock market wins over time in all cases. Now, stock market returns aren't the same in any 5 or 10 year period of time, but over the long term, they are quite reliable. I'll show you that in a minute. So over the long term, the stock market quite reliably wins when you have the same level of leverage. Okay, so you got to decide on the level of risk that you want. Basically, you want to decide on the growth and the risk that you're willing to tolerate, and how much growth you're looking for. The growth is usually part of your retirement plan, so you should think of what gets you to the life that you want, but also you still have to be comfortable with the risk level. Now, stock market investments with a 3-for-1 investment loan generally beat rentals. Now, a lot of people, you might be comfortable with a mortgage, but not an investment loan. I'm going to talk about that in a minute. In reality, what this comes from, I think you may find a lot of people are like that. They're comfortable with mortgages. They've always had a mortgage, but getting an investment loan somehow feels really risky. But it's the same kind of debt, and you're doing it to buy an investment, and both investments are pretty reliable long term, and they're not riskless. They both have their periods of time when they go down, but they're both pretty reliable long term. So the investment loan is generally pretty well as viable as a method as a mortgage. So, and the reason you think it's more risky is because you probably have an exaggerated view of the stock market risk. So most investors think the stock market is more risky than it actually is, and it's because they're focused on the short term. You see, it went down 20% last year, so that's the kind of, you could lose that much, and real estate doesn't go down that much, but real estate does go down that much. So back in the 90s here in Toronto, real estate fell by 30%. Now, it was a slower thing. We had 7 down years in a row from 1989 to 1996, 7 down years in a row, 30% decline. But then again, it comes back. So the stock market tends to, maybe fall more, but quicker, and also bounce back quicker. Real estate is this long, slow thing. But both of them have their ups and downs, and both of them are quite reliably up when you get to 20, 25, 30-year periods of time. Now, some people like rental properties for what I call it the snob appeal, right? It's because you can show your friends, I have this property, and it's it looks good. But you know what? As a financial planner, I'm more interested in you achieving your life goals and having actual money, as opposed to trying to pretend you have money and impress people. But yeah, showing friends your property versus talking about the stock market returns, may come across better. But as a financial planner, I would suggest try to have real money, not pretend money that you're showing. So, and also finally, my advice here is when you rent a property, this should be part of your financial plan, part of your retirement plan. So think about the long term. How does it fit in? What level of mortgage should you have? How much money should you put into it versus what else you're doing, RSP and TFSA and maybe investment loans and Smith maneuver. This is one piece of it, and think of it in that case of what to do. And you got to think of what to do long term. So, for example, a lot of cases I've seen with rental properties, they plan to keep it until they retire. But once they retire, they want to travel. They don't want to have this rental property anymore. So it's very often it's sold around retirement time. while stock market investments tend to be kept all the way through retirement as part of your retirement income. But you should think of the rental property in this plan. Like also, so some people just choose when they look at it this way is, okay, you know what? I'm going to commit to keeping this rental property all the way through retirement. I'm going to keep Smith and Reverne all the way through, and it helps give me more cash flow this way. And I'm going to find someone to manage it, or so I can still travel. But like, think of it as part of the plan. Like, when do you want to sell it, and how does it fit in with your overall financial plan? And so what that does is it makes you think long term, and you tend to make when you think long term, you tend to make smart decisions about investments rather than emotional or short term decisions. So now, how can you learn to think properly about risks of investments? Okay, so this goes back to I'm going to explain to you now how if you've got an exaggerated view, if you think the stock market is riskier than real estate, then I just want to show you, give you a sense of how you can be confident in the stock market long term. You got to think about it properly, and the big thing is think about it long term, not short term. Okay, so for us, we actually think of investment risk completely differently than the investment industry because we are fee-for-service financial planners. We're here to help you achieve your goal. So the investment industry risk is ups and downs, short-term ups and downs in the market. Oh, it was down 20% last year. That's risk. So now for us, we think of you write a financial plan, let's say your long-term rate of return. For you to have the life that you want, you need a 7 or 8% rate of return long-term. So the risk is defined. Investment risk is defined as your long-term return, 20, 25, 30 years or more. Your long-term return is less than that 7 or 8% a year you need to have the life that you want. Okay. So if the market falls by 20 or 30 or 40%, but comes back and you still make your 8% long-term rate of return, then that's not risk. However, if your investment never fluctuates much, but only makes 3 or 4 or 5%, so you've got no chance of making 8, that's a high risk investment. So to me is bonds and cash and GICs are the highest possible risk because you have a 0% chance of achieving the life that you want with this 8% rate of return. Okay. So when you think about investment returns and risk in the long term, in the way that affects your life and your financial plan, you think about it differently. Then you're thinking about it more effectively. Now, there's a great book out, Stocks for the Long Run. There's been 6 or 7 issues of it. The most recent one just came out a few months back. This is the best investment book out there. If you read one book, you should read this. It gets into all kinds of topics. And you read that one book, you're going to be an investment expert already. Also, learn the risk tolerance is a learned skill. Like you may have gone somewhere and filled out a risk tolerance questionnaire with an advisor or a bank or a robo advisor or something, and you tend to think it says I'm moderate, that's my risk level, but that's what you were on that day at the time that you filled it out. But you can learn to have a higher risk tolerance. So just like you probably may have been scared of air. I used to be scared of flying on a plane. The turbulence. So I had some low turbulence tolerance, and I was terrified whenever we had some. But I've flown lots, so now I'm not worried about it all. It's a skill you can learn, and basically what it is, risk tolerance is the ability to do nothing when your investments go down. Okay, so let's say you do a 3-for-1 loan, $750,000 loan. You put $250,000 a year in loan in $750,000 loan. It's a big amount. Your $1 million investments falls by 20 or 30%, so it's even less than the loan. Oh my God! But you know what? If you just do nothing, just leave your investments. Based on history, the stock market has recovered 100% of the time from declines, 88% of the time within 1 or 2 years. The longest it's ever taken, I think, is 6 years from top to bottom and all the way back up. So, which was really rare. Usually, it's much less than that. So just do nothing. It comes back with some time. That's all you have to do for risk tolerance is be confident in the long term and do nothing. So, and this to give you a really big picture. So this is all the way from 1800s, 220 years of data, and you can see that the rate of return. This is after inflation rate of return, has been very close to this long-term trend line. And you see everything, all kinds of things that have happened in the last 200 years, and yet the stock market has pretty consistently made a decent rate of return. Now, it looks very close to this trend line, but you don't experience it that way because this is, decades that you're ahead and behind and stuff. But But the 220-year average is basically 6.8, but a 6.8% real, which means let's say 7% above inflation is the long-term rate of return of the stock market. And it's been very close to that whenever you take long periods of time. And you can just see how reliable it is. And it's actually more reliable over the long term than bonds and cash or gold or other things. So this is actually the standard deviation, which is the odds of you getting a lower rate of return. Okay, so it's how consistent are your rates of return after inflation. And like if you think of it as a picture of risk, of uncertainty, you'll see that stocks are more risky than bonds. Bonds just pay interest, right? Stocks are more risky for 1, 2, and 5 years. And people think bonds are safe, but once you get to 20 or 30-year periods, bonds often lose money because they don't keep up with inflation, or because if interest rates rise, bonds go down. So bonds can have 20 or 30 or 40-year periods where they lose money. Stocks have never had that. Basically, any 20-year period of time, they've always made money after inflation. So they're more consistent long term than pretty well any other kind of investment. And yeah, more consistent over time as long as you stay in for the very long term. So again, when you look at ups and downs, I have a chart here with ups and downs. If you're listening to this as a podcast, then you don't see this chart. It's not on my blog, but go to the YouTube channel and watch it. The charts are here are there. So you see this, it's a chart of this is the Canadian stock market, and the yellow periods are all the declines, and they're not insignificant, 20 or 30 or 40%. But if you stand back and look at a 70-year chart, what you see is it's very definitely just climbing steadily uphill over time. So any longer period of time, the stock market pretty reliably makes a good rate of return. And so this is the US market, 25-year returns. I got 150 years of data here. And you see the worst it's ever done is 5%, but that was way back in the 1800s when the stock market was basically just railroad and agricultural stocks. So the modern stock market, which started around 1930, the lowest rate of return has been basically 8%. It's been 7.9, basically 8% a year rate of return. So any 25-year period, you're probably going to make 8% rate of return. And that's in a bad 25-year period. A good one, the average has been 10, 11, 12, That's been the long term up to the US market. Global a bit less, Canada lower than that again, but the point is, when you see the chart here actually shows when you're in for 25 years, it's very consistently a very strong gain. Okay, so, and that's the point. So if you're going to do an investment loan, especially a sizable one, the way to be confident in it is do it for 25 years or more, like commit to this as a long-term thing. Then you've got a really high chance of having a great result on it. And so I always have stock market predictions, and here, people ask me, what do you think is going to happen this year in the stock market? And, the truth is, I always have an opinion, but the truth is, I don't know what's going to happen this year. Nobody does. And, everyone's got an opinion, which may or may not be right. Actually, I've been right more than half the time in short-term predictions, but, based on some experience, but really, who knows? So, however, over 25 years, the stock market has consistently been up between 7 and 17 times. So you put 100,000 in the stock market today. In 25 years, it's going to be between 700,000 and 1.7 million. So you take any time in the modern stock market, the last 90 years, and put it in for that. You would basically any time you would within that range. So that's huge, right? That's a huge growth over the long term. That's why you need to get big amounts of money invested when you're young and let it grow. And that's the secret. That's the secret to building wealth. It's the secret to retiring comfortably. All right. Well, thanks for listening. So what you learned today is, how does growth of real estate compare with the stock market? What are the sources of rental property returns? What are the different sources? What's the normal return for each of those sources? How does the total return of rentals compare with the stock market? What are the best and worst types of rental properties? How do you minimize tax on rental properties? And we looked also as, should you deduct the depreciation, that's CCA, on your rental, and how do you figure that out? How do you record the sale of your rental on your tax return? A lot of people get that wrong. How does the size of the mortgage affect the return on your rental? And then we said, how do different amounts of leverage affect returns of rentals versus stocks? Now, I'm sure you've not seen that anywhere else. It's a really cool idea. It's really important to understand this, because rental properties are pretty well always people have a mortgage on it. Stock market, most of the time they don't, but they really, it is a really good similar kind of option or strategy similar to a rental property. Then we went through Ed's rental property rule of thumb. And then I can just give you my general unconventional wisdom, general advice on owning rental properties. All right, so thanks again for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. I also have a YouTube channel now and a podcast. You can go to find the YouTube channel, just type in edrempel.com/watch. You'll find my YouTube channel, or edrempel.com/listen. You'll find the podcast. I'm on 27 different sites, which you'll find there. You can listen to whatever your favorite podcast site is. If you're interested in potentially talking to us about a financial plan, just go to my blog, www.edrempel.com, hit the contact button, and then ask for a free 30-minute consultation. And again, we also you can help me spread the word. This is the unconventional wisdom, which is different from what you hear from pretty well anybody else out there. You can help spread the word by sharing it, and also subscribe to my blog, YouTube channel, and podcast. Thanks a lot for listening, and we'll talk to you next week.